Welcome back to the deep dive. Today, we're pulling you right into the current of change. We're looking at a figure who's really shaped modern venture capital for decades, Brad Feld. After this huge public career, with Techstars and his whole give first philosophy, he just stepped away for 2 solid years. And now he's back. He has a new book, and he's delivering these incredibly sharp post-burnout insights on, well, everything. From the erosion of values in tech to the uncomfortable echoes between the dot-com boom and today's AI frenzy.
Yeah, the source material we distilled for you is this remarkably candid conversation. It covers his whole 2-year absence and how he's re-entering the public sphere. It's perfect for our mission here. We're really distilling 2 core subjects. First, how do you maintain a value system? Something like give first when the very institution you built starts to value marketing over belief.
That's a huge question.
It is. And second, what are the painful, often repeated lessons from past market cycles that are absolutely essential for navigating today's, overwhelming momentum?
Okay, let's unpack this. We should start exactly where his book does, right? With his central operating system, the give first philosophy. It's his legacy. He mentioned the idea for the book started, about 4 years ago, trying to jam together these 2 concepts, you first, and this idea of genuine mentorship.
And what's fascinating is how often that gets misinterpreted. People think it's like some kind of transactional karma score. He really stresses this is not a set of rules you follow for some moral salvation. It's much more practical. It's about defaulting to generosity. It's what you do every day. You recognize the good and bad things happening, and you just operate with this default generosity without defining what you expect back.
So it's not just a nice slogan. It's a core operational rhythm. But for someone listening, trying to put that into practice, this default generosity, how do you stop from feeling like you're just being taken advantage of?
That's the critical distinction he makes.
Right.
He acknowledges that you do expect a return, eventually. But you have to accept that you don't know the timing or the source or the form it's going to take. If you go into every interaction expecting, an immediate ledger balance, you've broken the philosophy.
And that's exactly what he felt was happening at Techstars.
Precisely. The strain he felt was this exact breakdown. He and David Cohen just felt that Give First was becoming, in his words, much more marketing than it was value system in too many parts of the organization.
Wow. That institutionalization. I mean, when a really powerful, beautiful concept just becomes a marketable slogan, that must have been incredibly painful for the founders. It's like the ground shifting under your feet.
It was. And that unhappiness directly affected his work on the book. When he submitted the first manuscript, the feedback was harsh, but necessary. Reviewers told him it was too much Techstars, not enough Brad, that the stories weren't personal enough, they didn't connect. And that was a clear signal, right? Stop writing about the institution and start digging into the raw personal reflection that forced him to confront his own values.
And that need for raw personal reflection, that brings us right to this famous 2-year period he calls his hibernation. This wasn't some planned sabbatical. It was a deliberate retreat fueled by just absolute exhaustion. He was tired, bored, and frankly, just uninterested.
And you have to remember the timing. This was the middle of COVID, yeah, but more than that, the tech downturn was, as he puts it, in full blossom. So we're talking late 2022, early 2023. He's dealing with intense stress in his portfolio, the pressure of raising a new fund and all that volatility. It was grinding.
So the environment was just toxic and he needed out. But he didn't make a big show of it. He didn't write some annoying "I'm going on a blog vacation" post. He just stopped.
He just stopped being public. And that was crucial, so crucial for the reset. I mean, if you're trying to disconnect, announcing your disconnection just keeps the conversation focused on you.
It's performative.
Totally. And the specifics of his retreat are a huge takeaway for anyone facing burnout. He stopped posting and he stopped consuming. Social media, news, all of it, gone.
A total consumption halt. I mean, for someone at the center of the tech universe, that is radical.
Completely radical. He made one single exception for professional info. The daily email from TechMeme. That was it. Think about that filter.
Right.
He talks about spending 30 years being very visible, very open, and then suddenly having zero public profile was an enormous relief. That space he created by just refusing to feed the machine. Yeah. It was a massive recycle.
The power of choosing to be invisible when visibility has become a burden, that's a powerful lesson in boundaries. So how did he structure his return? It was tied to David Cohen coming back as CEO of Techstars, right?
Right, about a year before this conversation. He agreed to help Cohen in any way he could, but, and this is key, he insisted on maintaining no public profile. A firm boundary. The book became his path back, but on his own terms. He took the manuscript off the shelf, spent 6 months just working hard on it.
And the publication speed is almost unbelievable. It really suggests how urgent he felt the message was. His publisher, Idea Press, got the book out in 5 or 6 months. The industry standard is, what, 12 to 18 months?
That urgency definitely says this message can't wait. But the real question is, why break hibernation to promote it at all? He just reasoned it would be dumb to just publish it and not put any energy into being out in the world. The ideas were too important to just drop quietly.
That makes sense, but it's got to be a slippery slope back to the habits that caused the burnout in the first place. So what's his defense mechanism? This is the boundary lesson you should just etch into your memory.
It's the pumpkin deadline. It's brilliant. He publicly stated he plans to turn into a pumpkin on October 31st and turn it all off again. That's shortly before his 60th birthday in December. So it's a scheduled, mandatory exit. It's his way of actively stopping himself from sliding back into that unhappiness. He's scheduling his intentional absence.
That is a powerful connection. The personal reset enables the clear sight needed for market analysis. Let's pivot there now, using that clear sight, to the market dynamics. He was an active investor during the dot-com era, and his comparison between the late 90s and today's AI enthusiasm is, well, it's critical.
Yeah, we should really stress the most powerful, painful similarity between the two, the complete and total suspension of disbelief. It's just, despite 25 years of history, thousands of articles about the last crash, humans are just extraordinarily good at ignoring history and repeating the same pattern of collective self-deception.
It's the FOMO, the belief that this time gravity won't apply to this technology. But he pointed out a fascinating detail about the dot-com era that I think a lot of people forget. It wasn't just about pets.com.
Exactly. Most people talk about the consumer internet bubble. But he says 2 bubbles happened at the same time, and that even more money was lost in the simultaneous broadband bubble, this frantic laying of vast amounts of unlit fiber optic cable that, no one had customers for yet.
So wait, the critical nugget is that the real money wasn't lost on the failing websites, but on the infrastructure they were all supposed to use.
Precisely. It was a massive, speculative build-out of infrastructure, fiber, telecom gear, that just far outstripped any actual demand. Now think about today. The race for AI isn't just the software models. It's the frantic, multi-billion-dollar race to build data centers, get unprecedented amounts of energy, lock up GPUs. The parallel is that the financial risk might not be in the AI models themselves, but in the potentially over-leveraged, undifferentiated infrastructure supporting them.
That is a much more systemic risk. And when that kind of bubble bursts, he talks about the curve of pain. What does that feel like?
He explains the shape of it. The run-up, even when it feels fast, it has this kind of logarithmic, gradual slope up. Everyone feels like a genius. But the slope on the downside is much steeper. The pain is brutal. There's no gradual decline. It's just a sheer drop.
To really drive that home, he shares this legendary anecdote from his time at SoftBank involving a calendar company called Anyday.
Yes. SoftBank funded Anyday, one of like 17 competitors at the time. Peak bubble stuff. When they were acquired by Palm, they got a choice. $100 million in cash or $80 million in Palm stock. They took the cash.
A very smart move in retrospect. But tell us how steep that crash curve was for the option they didn't take.
1 year later, that $80 million of Palm stock was worth less than $1 million.
Whoa.
Not $8 million, less than $1 million. It just vaporized. That story really captures the brutal speed of the crash curve he talks about. It wasn't a gentle slide. It was a cliff dive.
Terrifying. It drives home the need for skepticism, which connects perfectly to the final theme he explored, the erosion of genuine public discourse and the extreme rise of tribalism in tech.
He actually marks the decline starting around 2012 or 2013. That's when he started to lose interest in public writing, because VC firms began hiring content people, often ex-journalists, to write what he calls quasi-marketing shit under the partners' bylines.
So that thoughtful, thinking out loud tradition of early VC blogging, where they were genuinely debating ideas, that was just replaced by content farms, churning out marketing fluff disguised as strategy.
Exactly. The authenticity was gone, replaced by calculated PR.
Mm-hmm.
And then came the failure of VC Twitter. He retreated from it because it became less about learning and more about people trying to show how smart they were, bloviating, dunking on each other. It became competitive and tribal, and the value he wanted learning was just drowned out.
This shift toward performance and tribalism led to a really major belief flip for him in just the last few years. He used to be an optimist about leadership.
He did. He used to believe that more leaders in tech cared about what we'd call long-term, multi-turn, positive sum outcomes. Now, to translate that jargon for you, positive sum means success is a pie everyone helps bake and share. Cooperation leads to better results for everyone over time.
And what does he see now instead?
Now he says he sees far more short-term, single-term, win-lose, zero-sum thinking. Zero-sum is the opposite. The pie is fixed, and your job is to fight to get the biggest slice, usually at the expense of others. He considers this extreme tribalism in leadership to be quite destructive.
And this destructive tribalism connects right back to the AI hype we were talking about. He warns the industry has mastered SCUPS, psychological operations, or misdirection. Wait, SCUPS. For the listener, what does a tech psychological operation even look like?
It's the deliberate focusing of public and regulatory attention on one issue to distract from a more immediate self-serving one. He argues the anthropomorphization of AI is so extreme that non-technical people assume confidence equals correctness. They hear these dire warnings and they get distracted.
So the leaders who are loudly warning about existential risks 50 years from now might actually be using that fear to distract from things like consolidating market power or avoiding regulation on their products today.
Precisely. They're focusing attention on things that are maybe decades away or already covered by existing laws,
Right.
while using that as misdirection from where the real financial issues and short-term monopolistic risks lie. It's a very tactical, zero-sum move.
So what does all this mean for you, the learner? We've looked at the need for a personal reset, a scheduled hard off date, and the absolute need for critical, skeptical thought during market hype.
And if we connect this to the bigger picture of investing, you realize that success, even at huge companies like Microsoft, is entirely power law driven. Which means it means a few massive wins, like Microsoft's cloud business mask, a graveyard of expensive failures. Remember Zoom, Skype, the Nokia acquisition, all failures. But their cost was absorbed by the few exponential winners. When you realize that, you stop chasing every trend because you know most of them are going to be failures. You focus only on the few true partnerships that can actually withstand those brutal crashes.
And that reframed perspective brought him to his final investment criteria, which are all about endurance and authentic partnership, not just hype.
He frames it around three core questions now. First, were you put on earth to work on this problem right now? That demands real conviction. Second, do you want to be partners with me as much as I want to be partners with you, which demands mutual respect? And third, do I have an affinity for what you're doing? That's the emotional commitment you need for the long haul.
Those criteria really emphasize that enduring values, that give-first mindset, have to survive the tribal pressures and the market volatility.
And that leads to a final provocative thought for you to chew on. If leaders in critical sectors are increasingly operating in these short-term, zero-sum tribal ways, how does an individual maintain the value of the combination of being an independent thinker while knowing they don't have all the context? The greatest power in this hyper-tribal, hype-driven age might just be opting out of premature judgment entirely. You need to consider the value of just reserving your opinion and simply saying, I don't know what I think yet, until the truth has a chance to rise above the noise.